Okay, recording this video Sunday 19th February 2012. Hope you're enjoying your long weekend. We've got President's Day on Monday, so the markets are shut on Monday. Day trading really doesn't resume till Tuesday. In the meantime, the overnight sessions are still open. Sunday evening trading is kind of open. Monday evening trading is going to be open, so we can still see what's kind of going on, but the day trading doesn't really resume until Tuesday. Anyway, so I hope you're enjoying a long weekend. Looking at a couple of charts this weekend, just going to record a quick video on those just to show you what I'm looking at. But in the meantime, just two announcements on software. First one, NinjaTrader users are the better indicators. I know you've been waiting for the NinjaTrader kind of versions. My NinjaTrader programmer is promising me Tuesday, Wednesday for the versions of those indicators coming out. So fingers crossed, that's when they will arrive. You never know, last minute kind of glitches, if anything's kind of doesn't look right, but Tuesday, Wednesday, so fingers crossed that's when I'll get those out. And the second thing to announce is the Emini-Watch app. So this is for users of Android smartphones. If you're interested in watching the Emini-Watch videos on your Android smartphone, you can now go to the Android market, search for Emini-Watch or Emini-Watch, and the app is there that you can kind of download to your smartphone. The purpose of the app is to be able to watch kind of the last 10 videos on the site. So it's a really simple little app. It allows you to see kind of the latest update. You can kind of download it on your Wi-Fi and kind of watch it on the go, or watch it on your Wi-Fi connection. Wouldn't suggest they're pretty meaty videos in terms of download, so I wouldn't suggest kind of downloading when you're kind of out and about using like a 3G connection or something like that. But you can certainly download them on Wi-Fi and kind of watch them on the go. So it's a little bit of an experiment for me just to see what kind of uptake there is for it. But there you go. Just go to the Android market, Emini-Watch or Emini-Watch. I'll put a link below this video to that. So if you're interested, go ahead, download it, have a look, give me some feedback. So there we go. Let's talk about some charts. And the charts that I'm looking at this weekend are all to do with kind of bonds, interest rates, dollar index. And let me just run through these. I've been talking about the rates kind of bottoming out for I thought this would be an important story this year, and I did a video at the beginning of the year saying, look at this with these rates kind of down here. This is kind of interesting, and I've just brought up the rate chart here. This is the 10-year interest rate. All of the 5-year, the 30-year, all look very, very similar to this. But basically, kind of last October, we kind of bottomed out in terms of rates, and we've been in this holding pattern, just holding on the 10-year around 2% between these cyclical support areas like this, highs and lows, just batting backwards and forwards, bang, 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 for a fair few months now. Now, what happens is, we move from trend moves into congestion moves, and then we move out into a trend move. So, we've had a trend move down into these lows. We're now been in congestion for a while. We're waiting for the next break into a trend move, and so what I'm suggesting is potentially we could have a move to higher rates. If you look, so this is the 10-year. Let's look on the daily chart at the 5-year. Here we go, same kind of pattern, into a trend move, into the cyclical highs and lows down here. And then if we look at the daily chart on the 30-year, same kind of pattern, pull back to dirty end of trend, cyclical pattern, bang, been holding around here. And on the weekly chart, on, for example, the 5 years, a good chart here, we kind of broke from, during, basically the story in 2011 was rates kind of coming down, finally ended with this move with pullback to end of trend, kind of down here on the 5-year around 80, 85 kind of basis points kind of down here. And when you look at the monthly charts for all of these things, you can see that where cyclical support has come in, and here on the 30-year, at a really significant level kind of historically, we've had support kind of come in. Let's go to another monthly chart of the 5-year. Again, cyclical turn, pull back to dirty end of trend, second cyclical turn after an end of trend. It's an important kind of point for me. And then this is the 10-year. Again, cyclical support kind of come in here. So, are we going to start to see rates kind of move up and bonds kind of move down? And when we go through the bond contracts, you can start to see these kind of topping out type patterns in the bond market. So here's the 30-year bond. This is daily, weekly, monthly time frames here. You can see on the monthly time frame, pull back to end of trend here. On the weekly chart, we had exhaustion buying here, blue professional bars taking profits. First bullish divergence pattern kind of comes in here. Got amateur bars here. What I found quite interesting over the last few weeks was this blue professional bar kind of goes up into those highs. Amateur up bar here, blue professional up bar, we kind of close on the lows. We're not able to take out those highs. If that was a down bar and we're kind of breaking the highs, that would have been professionals kind of re-entering. But to me, that looks like professionals kind of getting out, using that opportunity to get out 144, and the market's kind of moving down. And we're heading into, on the weekly chart, some kind of support area, because we've broken into an uptrend, a support area, somewhere in between where we are now and this kind of breakout level. And then when you go down to the daily chart, you can just see that pattern that we've seen on the rates, this kind of pullback to dirty end of trend, and all of this kind of cyclical activity in the meantime. This first exhaustion selling signal is a bit of a rush for the doors. We come back up, another exhaustion buying signal, and for me I call that last roll of the dice. That's the last opportunity for the professionals. And this cycle here with all of these blue professional bars was on that weekly chart. That kind of ended up being a spike up day on the weekly chart. You can see daily resistance, cyclical resistance kind of come in, starting to kind of move down. This support area is kind of really critical in terms of bonds. So going to the 10-year chart, exhaustion buying, first bearish divergence up here. 10-year chart on the weeklies, you can see here the same pattern, exhaustion, bearish divergence, Rambo patterns up at the highs here, bang, bang, bang. All these bearish divergence signals kind of go off, and then daily chart, same kind of pattern, just pull back to end of trend, all these cyclical patterns here, Rambo patterns, blue professional bars into the highs with exhaustion buying, and we're kind of coming back down to this cyclical support area here on the 10-year. 5 years, similar type thing, exhaustion buying, Rambo patterns on the weekly chart after first bearish divergence, Rambo patterns here, and then going to the daily chart, pull back to end of trend, this kind of cyclical activity, Rambo patterns here, and then we had exhaustion buying, bearish divergence. So you can see all of those bond charts all looking very similar in terms of just starting to roll over. Where they might roll over to is really, it's the weekly chart that kind of tells the story that, we've broken up into this uptrend. We still need to kind of test it with a pullback to end of trend sequence, but we could be seeing weakness in the bonds, into this kind of area over the next few weeks until we find that support. So that means kind of rates kind of going up. And something I was just kind of playing with today, when I start to, the story of, the correlation or non-correlation between the bond market and the equity market, just switches around. There are really big kind of cycles when they kind of move together and don't move together. But let me just show you this at least. This is superimposing the rates. This is the 5-year rates in red, superimposed on the equity market. This is the S&P index here, going back 12, 13 years over this time period, and you can see when you superimpose the two, the rates kind of are almost a measure of economic growth. And so the stock market is also a measure of economic growth. As things kind of get overheated, rates kind of move up. As we kind of come off in terms of economic growth, rates kind of come down, and so on. You can see the rates move kind of during this time period, rates kind of moving in parallel. When you go back over longer time frames, there are different kind of drivers and different things kind of going on. But if we look at over this time period, it's a fairly decent time period. You can see what's kind of going on, and we had overshoot in the equities market, where we had kind of the blow-off move in construction industry, house prices, and economic kind of growth into 06, 07, and the rates were showing us that things were going to kind of come off, and then so the rates started moving down. And then since 09, we've really had the Fed intervention, and with quantitative easing being a key part of the whole picture. Quantitative easing, QE1 was around here when the equity market was down. QE2 kind of came in here again next time we had the equity market down, and so QE1, QE2 kind of ran during these periods. I don't see the reasoning for the Fed kind of coming in with QE1 and QE2 was equity prices were down. Equity prices are up right now, so yes, we could definitely have QE3 in the future, but I just don't think the Fed reasoning for the announcements of QE was equity markets being down, and equity markets are up right now. So I think actually the Fed would probably be quite happy with themselves in terms of managing expectations, and that since the equity markets are up, therefore the real economy kind of might follow later, with kind of psychologically kind of getting people kind of more confident about the future. What I find interesting about this chart is the mismatch now between what the equity market is doing and what rates have done here. And so, if you believe that we kind of move back into people start to believe that the economy and the rate scenario is more normal, that we're not in a kind of end of the world type scenario, that things will start to come back in gear, and so you could see kind of rates effectively trying to catch up with the equity market. Now, how far up they might move, all I'm suggesting is that that I could see a scenario where the bond market over the next few months kind of heads down to find that pullback in an uptrend level, and so that means rates move up. And I also think kind of a continuation of the equity bull market, just because on the equity side of things I just can't see a lot of reasons for us turning around yet. So let me just go to this daily chart, the usual better indicators here. This was the sell-off that we had August, September, October. Exhaustion selling, blue professional bars kind of come in, first bullish divergence. We test down with flush patterns here, blue professional bars at the lows. We have Rambo patterns here with a flush signal, so the amateurs kind of getting wrong-footed. The next time we kind of come into some weakness, blue professional bars support kind of holds, we're off into an uptrend. Now on this uptrend you can see better momentum. This is like Goldilocks kind of better momentum. It's like it's not too hot, not too cold. It's like kind of perfect. There's no kind of blow off activity showing a blow off of steam and some kind of explosion into getting the amateurs sucked into the market while the professionals are getting out. The last blue professional bar that we had was actually on this down move here, and we're kind of breaking above the highs of that blue professional bar. This is where the markets opened on Sunday evening at 68, kind of gapped up. And so when I look at this chart and I look at all the kind of the signals in terms of volume patterns and so on, the only weakness that I could see over the last couple of weeks, we had high volume churn bars on the weekly weekly bars showing quite a lot of low range bars, relatively high volume. But better momentum is not saying that we've got kind of exhaustion patterns or bearish divergence patterns or whatever. So I could just see us eking out this uptrend, just kind of keeps on going. And alongside that, so the rates are kind of historically low. We've got blue chip corporates paying good dividends, and so is the money going to start flowing from the bonds into blue chip high dividend yielding equities, kind of pushing the equities markets forwards until those valuations and those rates kind of come more in line, if you like. I should note this was the 5-year. You can look at this on the 30-year and the 10-year. So that was the 30-year. The picture's kind of similar but not as good as a match as the shorter term. This is the 5-year, so it's a better match in terms of that sequence. This was the 10-year. Again, you can still see that pattern yet there. It gets a little bit kind of hidden, if you like, on the 30-year, but the 5-year, the shorter term, is kind of a little bit better. But the point is that do we see kind of bond rates having to rise in order to attract funds into them, because the money's being pulled into the equities market, because the equity market is going up, and we have a lot of kind of blue chip high dividend yield kind of plays in the equity market, and so people are saying, well, I'd rather get that with a little bit of a capital upside, capital appreciation upside, than putting my money in bonds and getting kind of historically low levels. So that's kind of the reasoning for me behind a continuation of this bull run in equities. I mean, I find it difficult to justify those things, because I see a lot of structural weakness in terms of what's going on in kind of global markets and so on. But you have to go with the flow. Dollar index, so if we see kind of bonds kind of coming off, we see a similar scenario kind of in the dollar index. And so let me just show you, dollar index. I've been bullish on the dollar index because we certainly had on the commitment of traders over the last 6 months during the mid 2011, we had the support kind of come in here, we had exhaustion selling down here, we had commitment of traders bullish divergence type signals showing, and we've had a rally in the dollar index. But we're coming up to these type of exhaustion buying signals here. I think cyclical turning point is due at some point, but not quite yet, and it's certainly not in yet. If you go to the weekly chart, so this was kind of the downtrend that we had, and this was this kind of bottom being made at 74 blue professional bars. We test with amateur down bars here. We've had some kind of run to the upside, but we've had exhaustion buying on the weekly chart. First bearish divergence, Rambo patterns up here into 82. So we could be kind of rolling over here. And then we look at the daily chart. On the daily chart, this is back in 2011. We made this bottom testing, amateur testing bars, went into this uptrend, came back. This big spike blue professional bar, the professionals bought down here. We held, we rallied from there, but the rally from there has been fairly weak, and we've filled out with a pullback to end of trend move with a amateur bar at the top there. And I'm worried. This bar was on Thursday. So, we've been held on the weekly chart with cyclical support, but no blue professional bars on the weekly chart. We've had professional activity here. This professional activity, we're breaking to the downside. So on that little spike up to, 80 and a half, where the professionals kind of just getting out here, kind of selling this short. So I could see some weakness in the bond. I'm not convinced of this yet. Friday's activity, was for a long weekend. Who knows what's kind of going on there. Certainly we've got to wait till kind of Tuesday, Wednesday's activity to see what happens here. But if we continue on down here, I suppose what I'm saying is I won't be surprised if we see weakness in the dollar because of that. But if we break above this on the high of this, find support here and come back up, then that kind of hypothesis kind of goes out the window. But it's just kind of looking at that. It's a little bit of a spike up, kind of closed down, and we're kind of breaking towards the lows of that bar. So that's what I'm looking at there. And then you got to look at the the trend, and this is a better X trend, and this is how I look at it on a whole bunch of charts. So this is the Dow, Nasdaq, this is the S&P 500, and then I look at it on the futures contract, just on the daily data and the overnight session as well, and then look at that on the weekly chart as well. And you can see, look, we've been trailing our stops up. We trailed this stop up on the Nasdaq the other day. We're sitting in these uptrends on better X trend, and on the weekly chart we've not had some kind of exhaustion buying activity to pull up the this trailing stop. Thursday's, Friday's activity, we kind of trailed the stop up here. So we're in an uptrend. So and to finish off this uptrend, we'd have to see a pullback to end of trend on a 135 or a daily chart. And we tried that, kind of 10 days ago on the 135-minute chart. Didn't work out. We kind of kept on moving through it. So we're in an uptrend. And I look at those bond markets, kind of elevated bond markets with really low rates, and start thinking, well, if the money starts switching out, we'll have a continuation of the equity run and a move out of bonds. What else I've got to show you? So tip bar charts, look at these on the 40,500 tip frame chart. So this week's activities, so Friday, Thursday, Wednesday, Tuesday, Monday, kind of gapped up on the Sunday night. We'd had some weakness on Thursday into Friday, and then so we're kind of just playing around these cyclical highs and lows till we get the next exhaustion selling signal. Bullish divergence kind of comes in on the Wednesday down here, Rambo pattern right at the lows, and we come back up. So we're breaking above. Saying 1350s was kind of an important level. We now, we played on Thursday and Friday into the 1360s, and those kind of, seemingly weren't a lot of profit taking there. And we kind of busted up to 68s, in the overnight. So 13,500. This was the activity. So we had end of trend. We had a pop on Wednesday into. The beginning of Thursday, the market kind of comes down. Exhaustion selling, bullish divergence kind of comes in. Rambo patterns, and we reverse and we go the other way. I know we had these blue professional bars kind of coming on the 13,500, but they were kind of buying through this resistance. Wait and see. Again, in terms of better momentum, we've not had that exhaustion buying here. We're making pullback to end of trend, which we'll probably get with this kind of explosive activity here, but we need to see some kind of exhaustion buying signal to come in with that as well. 4,500 tip bar chart again into this kind of Wednesday, Thursday, Friday move. We bottomed here, Rambo patterns. We had that spike down here with exhaustion selling at this point. Blue professional, another kind of exhaustion buying signal, getting this move kind of going, and it ran to pull back to end of trend in here. We kind of had a flush signal on Friday, and we kind of sold off. But mid-Friday, we had exhaustion selling kind of down here, bullish divergence kind of comes in, the market holds, and we rally from there. So, just have to go with the latest kind of exhaustion, bullish divergence kind of signals, and in terms of direction and where they're kind of going. And these are really useful signals in terms of these turning points. And for me, those are the step one in terms of turning points. Let me just compressing this bar up, showing a week and a half or whatever. So just looking at the first bullish and bearish divergence signals. So bullish divergence, bullish here, another one here, bearish here, bullish here, bearish here, bullish here, bearish here. Now when you see them in the middle of a sequence here where it's wait for pullback to end of trend, you need to wait till the move kind of completes. I'm not saying get in on these signals. You have to wait for a completion of a trend move, and then I'd suggest waiting for an amateur up bar or a professional up bar that gets broken on the lows as a testing kind of bar. But on the 4,500 tip bar chart and then on the 1,500 tip bar chart, these are really useful in terms of showing us where we start to lose the buying or the selling kind of pressure in the market, kind of can get ready to kind of just reverse. So that was kind of Friday's activity. It kind of sold off into this move and then kind of rallied on. Just in terms of the 1,500 tip bar charts, just kind of note this. So got short with these amateur up bars. I was short 59.25 on this retrace kind of back here. So we'd had our exhaustion selling bullish divergence signal here into a pullback to end of trend. All these blue professional bars kind of come in at the highs. We test it with amateur up bars here. That shows kind of weakness, and we start going the other way. So I was getting short at 59.25. Stupidly, I didn't kind of hold just all the way to my end target. I kind of jumped out, got a little bit scared halfway through, and so did it in actually 3 trades for 2.5 points on the way down. But getting in on the way up, we had these amateur down bars here, which were showing kind of weakness. Amateurs kind of getting wrong-footed. As soon as the highs of that kind of get taken out, remember on the 4,500 tip bar chart, we'd had exhaustion selling, blue professional bars kind of coming in, bullish divergence being made. So we knew that was an important kind of support level here. So that was the time to get in here. Then I came out at what did I come out at 58, because this was just bizarre. We moved a point in like an hour and a half, and then we jumped to a next level here, and we held here for like an hour and a half. It was just totally bizarre. And I know, it's a Friday leading up to a long weekend. In the afternoon, lunchtime kind of activity. It was going to be slow anyway. But that it just moved within this tight kind of range for so long was just utterly weird. So I just got out at 58 and just looked at it in kind of disbelief. Anyway, kept on rolling up till we get our exhaustion buy signal here. But pullback to end of trend just being made here. There's probably a big bearish divergence up here at on the 68. 1368 kind of level up here. Yeah, we'll wait and see what kind of happens. Lot of time to run before we go to Tuesday's trade. But anyway, just wanted to show you those charts. So bond market kind of charts. Is this one of the important stories over the next 6 months or so? In that we have this kind of bottoming in rates, and all of a sudden rates kind of burst to the upside, and kind of the bond market kind of comes off, and that would mean some money flowing out of the bond market into the equity market, and the equity market keeps on just rolling up, slow roll kind of up until we get some kind of exhaustion signal. It kind of turns and goes the other way. Anyway, so there we go. Just some thoughts on the weekend. Hope you're enjoying your long weekend. And if you've got an Android phone and you're interested in the app, just head over to the Android market, or try the link at the bottom of this video.